Um, Popo Limited is considering a project requiring an initial cash outlay of 150 million shillings. The project's life is 5 years, after which there would be no expected salvage value. The possible incremental after-tax cash inflows and associated probabilities of occurrence are as follows. The company's required rate of return for this investment is 12%. Required, using decision tree analysis, compute the expected NPV of the project and compute the standard deviation of the expected NPV in BI above.
Thank you so much. This question was tested on April 2022, and I think it should be question number 5B. This question reminds us to keep on doing our revision and understanding on how the decisions are basically made when we are using our decision tree analysis. If we can be able to remind ourselves on how these decisions are basically made, we said any problem which we are going to be using a table, a decision table, we can also use a decision tree to arrive to a certain decision. And in this case, I can see an examiner is giving us a very small and reminding us about where we are coming from. Because I remember this problem already, we encountered it when we were doing the valuation models or valuation concept in finance, when we were doing financial management. And basically, we have to be understanding very well the aspect of the aspect of annuities and lump sum, and how are we supposed to be getting the discount factors when we are given a specific period, a longer period when it comes to annuities, like what we can see the net cash flows of year 2 to year 5. A lot of problems in the question was arrived due to uncertainties on how we are supposed to be getting that discount factor. But I just want to explain to you that when we have been brought this kind of a problem in a question, it means that we are going to be factoring a discount factor for year 2 to year 5. It means we are not going to be considering any discount factors for year 1. So in this case, when we are calculating it, it means you have to be taking the total value or the total discount factor for 5 years, and then we subtract for year 1. It means that once we subtract year 1, the difference will be covering the discount factor for year 2 to year 5. Now, due to our colleagues who are joining our today's session for the first time, let me just start by drawing the question. I think my board is visible. So I will start by drawing the question so that we can be able to understand on how are we supposed to be handling the question. I remember we said we normally use 2 decision criteria or 2 decision nodes. We said this one basically means a decision node. The decision which is basically, it is a decision which already lies with the management. But this one, it normally means the state of nature node. So when we have this kind of scenarios, it means that this one I can be able to make a decision on my own. I can say I can invest or I fail to invest, for instance. Then this one, it means I don't have any control for this, right? For example, when you are selling the shares to the public for subscription, you don't have any decision, for instance, to make people get attracted to the shares which you are issuing for subscription. This is just the basics for drawing a decision tree. Now, in that aspect, when we come back to the question, I can see that the examiner is giving you a decision to make, for instance, when it comes to the investment, and in this case, we are being told that. A minute, please. Thank you. Now, in this aspect, we are being told that the company is considering a project requiring initial capital outlay of 150 million shillings. So the project life is 5 years, after which there would be no expected salvage value. The possible incremental after-tax cash inflows and the associated probabilities of occurrence are as shown below. So in this case, the examiner is giving you the probabilities of getting the annual net cash flows of around 40 and 45 million Kenya shillings. In that case, we remember we are also given the conditional probabilities for the 3 expected outcomes. We cannot be able to control these outcomes, and then we are going to be using the states of nature for year 2 and year 5, for instance, and also for year 1. You cannot be able to control how the company is going to be making certain profits unless the demand and supply forces favors your business. So the company's required rate of return of this investment you will be given is 12%. So you have to be making 2 decisions here. I can make a decision, so that is why I'm using that a decision node. So I can make a decision on whether to invest or not to invest. Right? How much are we investing? Remember, you are going to be investing around 150 million shillings, right? That is the investment. That is your initial outlay. Because already the questions tells you to use the decision tree to solve the problem. So once we invest, we might be getting 2 expected cash flows. And these expected cash flows are going to be, we can be able to get them under year 1. So in this case, we are going to be getting either 40 million or we are being given 45 million, right? The probability of getting these expected cash flows, we are being told is 0.5, 0.50, and also here 0.50, yeah? This is year 1. That is year 1, correct? Now, in this case, we are being told if the project does well, for example, if year 1 I'm going to be getting 40 million, then we can also be having the net cash flows through the based on how we are going to be performing under year 1. So for example, for 40 million, we can be able to get either of the following. So we have 1, we have, they are looking like that. We have 3 options there. Then the first option, the first cash flow, we can either get 40 million. What is the probability of getting 40 million? We are being given 0.20, right? Then the second one, we can get 50 million. What is the probability of getting 50 million? We are being given 0.60. Then what is the probability of getting the last? We are being told 60 million. The 60 million, we should be also having a probability of 0.20. The probability should be equal to 1. Then also here, we have 3 options. We have 3 options there. So in this case, the first option, we can get 55 million. 55 million there. The probability of getting that 55 million will be given 0.10. Then the second one will be 0.70, right? For getting 60 million. Then the last one will be how much? 65 million. Getting around, this is 0.20. Correct. Now, the examiner is asking you to compute the expected. That is the requirement number 1. We are being asked to calculate, to compute the expected net cash flows, the net present values of the project. And I will be able to remind you that when the examiner is giving us that kind of a question, we know that to get the expected, this is what is basically required from us, right? You are required to do what? We are required to get, when we are required to get the expected net present value, we normally take the summation of the NPV times joint probabilities. Joint probabilities. That is what we are supposed to be doing. So in that regard, to get our summation, this one, it means I need to be able to understand this concept of the time value of money, where we are discussing about annuity. These cash flows are going to be experienced under year 2 to year 5. So in this case, it means to get these cash flows, right? These you know very well is an annuity. And this one you know is lump sum. I know now up to the point where I was able to cover that. You are, if you are able to check on the previous videos, now you are able to understand that. You are able to understand that. You're able to understand. I'm trying just to adjust my camera to make sure that it is very clear. I think a bit now is clear. So in this case, it means if we need to get our NPV, right? It means we have to be taking the present value of the cash inflow minus our initial outlay. I have said you need to take the present value of the cash inflow minus your what? Your initial outlay. Then at the end of the day, this one will be able to get your NPV there. Correct. Now, in that aspect, I just want to start by looking on the cash flows using the first branch. You can see the branch for 40 million. So it means my first workings, it means I need to have a lot of workings there. And I will be able to start with the first one. So the first working will be incorporating the 40 million, which you are going to be getting. That is the cash flow for the first year. So it will be 40 million. And remember that that amount is going to be received once. And that is why I talked about lump sum. So that is where we multiply by the present value interest factor. The discount factor will be 12%. 12% 1 year. Plus how much? Remember, when we look on the year 2 up to the lapsing of the project, we're also going to be getting 40 million, right? One of the options. Then we multiply by the present value interest factor annuity, right? We talk about 12%, 5 years, right? But we have a small working here because we need to subtract. We have been told from year 2 to year 5. It means we are not interested with year 1. We are not interested with year 1. So in this regard, if we are not interested with year 1, we need to subtract it. We need to subtract it. So we subtract the present value interest factor annuity, 12% 1 year. Then it means I'm going to be remaining with year 2 to year 5 after subtracting year 1. If examiner is giving you 3 to, for example, if it could be 3 to 5, it means I'm going to be taking 5 years. I subtract 2 years. Then I will be able to remain with a discount factor for year 3, year 4, and year 5. Then after doing that, we subtract our initial outlay, which is 150. So it means here we are going to be getting our NPVs at the end of the day. Now, to break this down, I said we have 2 kinds of formulas. The formula for lump sum, it is always 1 plus R. We raise for a negative N. Then the formula for these ones, I said, we normally take 1 minus 1 plus R, we raise for a negative N. We divide by rates. Divide by rates. Those are the formulas which we are supposed to be memorizing. So in this case, it means if I want to get this one without using a table, I'm just going to be taking 1.12, we raise for a negative what? Negative 1, right? It means I'm going to be raising to negative 1. So if you are taking out your calculator and you just want to get that, I just take 1.12, I raise for a negative 1. I'm getting 0.8929 times 40. Then plus, here we are discussing about 2 concepts. I have to be getting the discount factor for 5 years. I subtract for year 1, right? So you take your 40. Let me remove this million here because I have limited to millions. So in this regard, it means I'm just going to be taking 1 minus 1.12. We raised for a negative 5. Let me start with this one. Then we divide by 0.12. So how much am I getting here? So in this case, it means I'm just going to be taking 1.12. I raised for a negative 5. Then once I get that, I take 1 minus my answer. Then we divide it by 0.12. I can see we are getting 3.60. 3.6048 minus. Then I repeat the same scenario with 1 year. Right? Let us see if we are going just to be getting a similar. Because remember, year 1 for lump sum and annuities normally look the same. So let's just repeat with year 1 and we see whether we are getting the similar answers. 1.12, you raised for negative 1. 1 minus answer, then we divide by 0.12. You can see you are getting 0.8929. What is the difference? The difference will be resampling year 2 to year 5 as per the expected cash flows which you are going to be getting. So in this case, I just take 3.6048 minus 0.8929. We're going to be getting times here 2.7119 minus our initial outlay. So our NPV here will be how much? So let's start with the first one. Our NPV will be 40 times 0.8929 minus, should be 8929 plus 40 times 2.7119 minus 150. We should be getting around, what have I done? Let me check. It should be 0. Correct. It should be 40 times 0.8929 plus 40 times 2.7119 minus 150. We should be getting negative NPV, negative 5.808. Correct. Now let us go to the second branch of 40. We have 40 for the first year, but now we have the second option of 50 million. So it will be just the same. The discount factors now to memorize nazo. You're not going to be calculating again. So it will be 40 times 0.8929 plus, now the second one, the cash flow for the year 2 to 5, now changes to 50 times 2.7119 minus our initial outlay of 150. So allow me just to be editing from my my data which I was able to key in on my calculator. So what I'm getting, once I do all these, I'll be able to get 21.311. Now the third one will be how much? The third one will be 40 times, now it comes to 0.8929, nothing is changing there. Plus now the cash flow for year 2 to year 5 changes to 60 times, right? 2.7119 minus 150. So how much it is? How much it is? Allow me just to edit my data, right? Which is 60 now, getting 48.43. And if you are not understanding, guys, allow me to just let me know. Now we have finished the first options. Let us now look on the, when we are getting the cash flow of when you are getting a cash flow of 45 million in the first year, how will it be? So the second one now, we are talking about the working number 4. It will be, remember now we are getting a cash flow of 45 million. It will be 45 times, the discount factors are not changing, 8929. Plus now, the second option, the year 2 to year 5 changes to 55, right? One of the options, 55 times 2.7119 minus 150. So how much are you getting there as NPV? How much are we getting as NPV there? So allow me just to edit now to 45. And then I go all the way to 55. So I'm getting around 39.335. I know that you are writing. Then working number 5. Working number 5, we still have 45 times 0.8929 plus, the other one will be now from 55 to 60 million times 2.7119 minus 150. Minus 150. So allow me just to edit my 55 now to 60 from my calculator. You can just key in to confirm the answers. So the other one will be 52.89. 52.89. Then the other one will be number 6. And the last one, it will be 45 million multiplied by 0.8929 plus, we talk about 65 times 2.7119 minus 150. So how much are we getting here? So mine, I'm just editing from 60. Now we are discussing about 65. And the last answer will be 66.45. 66.45. That is how the computation was supposed to be. That is how the computation is supposed to be. Once we finish doing that computation, once we finish doing those kind of computations, you just need to when those computations are done, it is very important now to calculate, because already examiner needs you to get the expected net present value. It means now we have to be working on our joint probabilities. We need to be working on our joint probabilities. We need to be working on joint probabilities in order that you are able to see the board. Now we can be able to work on our joint probabilities here. I know that you are writing, but let me try joint probabilities to do as you follow. Now we start from here, right? So the first one will be 0.5 times 0.2. How much are you getting? I know that you can be able to get 0.10. Then the second one will be, now this one, the joint probabilities will be 0.5, 0.6, getting 0.3, 0. Then also this one will be 0.5 times 0.2, getting 0.10. What about this one now? Right? We are just taking the probabilities. So 0.5 times 0.1, we are getting 0.05. The second one will be 0.5 times 0.7, getting 0.35. Then this one will be 0.5 times 0.2, and I can see we are getting around 0.10. 0.10. I said if your writing is very key, then you can be able to tell me, Mwalimu, I've finished writing because I just want to wrap one of the areas. But no, we can be able to proceed. I can see a space somewhere. So to get this expected and net present value, let me just take my NPVs. I multiply with my joint probabilities. So let me start with the first one, 0.10. This one will be 0.30. This one will be 0.05. This one will be 0.3. 1, 2, 3. 0.1, 0.3, 0.1. 0.10. Then the other one will be 0.05. This one we multiply by 0.35. Then the last one, we will be able to multiply by 0.10. As you continue writing, I can be able to do this one. Then I do your summation. So this one will be, let me see, let me just use my calculator. So 5.808 times 0.1. I can see I'm getting 0.58. Let me just use 2 decimal places. The other one will be 21.311 times 0.3. I'm getting 6.39. The other one will be 0.48. Then we have 39.335 times 0.05. We are getting 1.97. We have 52.89 times 0.35, getting 18.51. Then the last one will be 6.65. So what is the summation now? Is someone who is telling me something? Let us factor IMO, huh? Mwalimu, why are you subtracting the present value interest factor? I missed that point. Very good. Very good. So Ali, we are saying the subtraction of the first year is because the cash flows which we are working with is from year 2 to year 5, right? So it means the present value interest factor for year 1 is not needed because we just need the present, because already when you look at it, you need just to do for 5 years minus 1 year to remain with a discount factor for year 2 to year 5. That is why we are subtracting the first year. That is why we were able to subtract the year 1. That is why we were subtracting it. Understood? Sorry?
Yeah, I've got that point.
Sikupati, I'm not getting you.
I'm saying thank you. You have
Oh, thank
clarified
you.
the
Okay.
point.
So, okay. So you see, I have already gotten the expected NPV there. Then it means I just need to get that summation. So to get the expected NPV of the whole project, it means I need just to be taking 0.58 plus 6.39 plus 0.48 plus 1.97. We have plus 18.51, right? Plus 6.65. 6.65. How much are we getting? 0.58 plus 6.39 plus 0.48 plus 1.97 plus 18.51 plus 6.65. I'm getting around 34.58. 34.58. That is how you get the expected NPV. That's how you normally get the expected NPV. Expected NPV.
I have a question.
Okay.
For the first one, the first NPV, it was negative 5.8. multiplied by
Oh, okay. Yes, yes. This is
was an
negative.
absolute.
Thank you so
Yes.
much. Thank you. Do you need to continue?
Yeah.
Is that okay?
Yeah.
Thank you. Thank you. That's what you should. Getting around, it should be 33.42. You can be able to confirm also. Let's confirm your answer.
Yeah, I got the same.
Okay, okay, thank you. Are we still writing? It's very important. If you are done, let me know. So the second requirement is telling us that the second requirement allows us to compute the standard deviation of the expected net present value in B1 above. And when the examiner is giving me this kind of a question, I'm supposed to be smiling. I'm supposed to be smiling. I'm supposed to be smiling. Why? Because already to compute a standard deviation, you just need to get the root of variance. You just need to get the root of variance. And now we're going to be getting this. They're very simple. It's very simple because to get to a standard deviation, we said, let us take the root of, we take the summation of NPV minus the expected NPV, right, squared, then you multiply by the probabilities. Multiply by the probability. I just want to start with the first one, although I have already deleted my, I have done very wrong. Oh, I have them here. I have my NPV there. So in this case, we start with the first one. So the first one will be negative 5.81. Let me just use 81 minus our expected, which is 33.42 squared. Then you multiply by our first joint probability, which is 0.10. The second one will be 21.31 minus 33.42 squared. Then you multiply it with the second joint probability of 0.30. The third one will be 48.43 minus 33.42 squared, then you multiply by 0.10, right? Number 4, we are going to be taking what? Number 4, we have that 9.34 minus 33.42 squared. Then I multiply by 0.05. This is our next joint probability. Number 5. Number 5 we have, I can see we have 52.89 minus 33.42 squared. Then I multiply by 0.35. Then number 6 and the last one, we are going to be having 66.45 minus 33.42 squared. Then you multiply by 0.10. How much are we getting there? How much are we getting? You just need to take our calculators. The first one is negative 5.81 minus 33.42 squared. Then I multiply by 0.10. We get around 153.90 once we round off. The second one will be 21.31 minus 33.42 equals squared. Then you multiply by 0.30, getting around 44. Once you round off, 48.43 minus 33.42 squared. Then you multiply by 0.10, getting around 22.53. The other one will be 39.34 minus 33.42 squared. Then you multiply by 0.05, getting 1.75. The other one will be 52.89 minus 33.42 squared. Then you multiply by 0.35, getting around 132.68. You can be able to confirm those answers with you. 66.45 minus 33.42 squared. Then you multiply by 0.1, getting 109.10. So what is the summation here? So we start with 109.10 plus 132.68 plus 1.75 plus 22.53 plus 44 plus 153.90. I can be able to get around 463.96. 463.96. Now, once I get this, right? Once you get that, then it means I just want to root. So the standard deviation of our variance, which is 463.96, should be equal to how much? So the root of my answer should be equal to 21.54. 21.54. Are you getting the same as me? You still getting the same answer?
Yes.
So you can just type. Just type down there, I'm done copying, so that we can do something different. Just want us to do something different. Let me just know when you are done, please. Thank you, Dawn. Done copying, Irene. Thank you. So it means we are all done. So let me look on something. The second, I think it should be the second technique of boundary risk, and which is mostly tested. Let me work up with or work on simulation analysis. One thing we need to understand about simulation is to imitate a reality. To simulate is to imitate a reality. And therefore, it means when you're going to be provided with a certain data, right? We are going to be, the first stage of doing simulation, it is to compute the range numbers. And the range numbers, we are going to be making our decisions, by the way, using simulation by factoring a trial and error experiments. Correct? So number 2 should be simulation analysis. Simulation analysis. This is the topic which is mostly tested. We can be able also to know that it is not a new topic to us. It is something that we have already learned there before. So it means when you look on our notes, which I shared with you regarding simulation, it means that we are saying simulation analysis is a statistically based approach that applies predetermined probability distribution and random numbers to be able to assign outcomes in each trial. And that is why we are talking about each experiment. In the context of capital investment appraisal, random numbers can be used to assign price per unit, variable per unit, volume of the output in each trial, and hence it's possible to determine the net operating cash flow of a project in each trial. Therefore, the NPV of a project in each trial can also be determined, and hence expected NPV of a project shall be determined as follows. You can see there. Now we should be getting our expected NPV. I will be able to teach you about that. So where the expected NPV is positive, the project is acceptable and vice versa. These analyses will provide an accurate result if 2 conditions are met. 1, the probability distribution of the variables is reliable. If many trials are conducted so as to attain a steady state, a stable state, you can say that. So even though this is a useful analysis, we are saying that it is used to incorporate the aspect of risk in capital investment appraisal. So the analysis suffers from certain shortcomings. 1, can be costly and time consuming. Remember, examiner is going to be telling you to give out the disadvantages of simulation analysis. So it can be costly and time consuming, the absence of computers, because to attain a steady state, many trials must be conducted. Number 2, we are saying that the analysis can provide misleading results if the probability distribution of a variable is not reliable. Then number 3, we are saying simulation analysis cannot provide an optimal NPV, since this is not an optimizing technique. Then number 4, we are saying, the last one, a complex simulation problem may resolve or may require the input of management scientists so as to model and probably solve using probabilities. So therefore, the results from the analysis might not be meaningful to finance managers of the organization. Now, when you come across such kind of information, it means that you are able to know that when you are doing your simulation, I said, to get our random numbers, we are going to be using the trial and error experiment. And we have said it in the first stage of doing our simulation analysis. In that regard, I will request you to open your past papers. We are going to be doing a question in November 2018, question 2. November 2018, question 2. Let us go there. November 2018. Question 2 here. So let us do this together. So it's ready for us. Who has joined the last person who has joined us? November 2018. Question number 2B. Question 2B. Someone should be just, someone should unmute and start reading. Someone? Kindly go on. Nobody.
Galanema Limited is considering to introduce new cheap plastic rollers into the market. This will involve investing in a new plant at a cost of 280 million. The plant is expected to have a useful life of 5 years, at the end of which salvage value will be nil. The firm's policy is to depreciate all its fixed assets on a straight-line basis. Due to market uncertainties, the unit selling price, unit selling price, unit variable cost, and annual sales volume, the new plastic rulers have been estimated as follows. Unit selling price, unit variable cost, annual sales volume. Additional information, the firm expects to incur fixed operating costs, excluding depreciation of 30 million in each year. The company's cost of capital is 17%. The corporate tax rate is 30%. Required, the expected net present value of the new product. Simulate the net present values using the following random numbers and compute the expected net present value of this project.
Thank you so much. So it means we are not supposed to be taking lightly the questions of the simulation, since you can see the marks these questions are giving you. Remember, if you have 14 clear marks under simulation analysis, you can just be in a position to pass the exam. So that is how important it is. So in that regard, you can see we are being given the initial outlay. So we are just going to be following a process of computing the NPV. Then we are going just to be determining, the expected net present value of the project, basically by the NPV of the new project. Then we are being told to simulate the net present value using the random numbers provided. So that being said, done, it means that before we simulate, first we have to be computing our NPV. So remember, when I look on the procedure or the stage which we listed earlier, we said we have 3 stages on the computation of NPV. First, we said we have the initial outlay. 2, we said we have to be calculating the annual net cash flows. 3, we have to be getting the terminal cash flows. But when I look on this question, it doesn't have much workings. What it needs, because we are calculating the expected, because that is what I can see, the expected NPV under the requirement number 1, then it means we are going to be incorporating the data which we are being provided due to the market uncertainties. We are being given the unit prices with the selling prices, with the probabilities, the variable cost with the probabilities, and the annual sales volume, just to make the work easier. So let me go to my board and provide a solution to the question. So in this regard, remember, I just want first to get the expected. The first thing that I want to be getting, before even I do those NPVs, I want to get the expected. I want to get the expected selling price. The expected selling price. How are we going to be getting our expected selling price? It's very simple. Because we are just going to be taking the values provided for NPV, for the selling price, then we multiply by the probabilities. For example, the first one is 35. We multiply it by 0.30. Plus, the second one will be 30. Multiply by 0.40. Then we add the last one, which is 50 times 0.30. So how much are we getting in terms of the selling price? So I just take my calculator, that 5 times 0.3 plus 30 times 0.4 plus 50 times 0.3. I can see we are getting that 7.5. Number 2, we need to compute our expected variable costs. Our expected variable cost, we do the same. So in this case, our expected selling price, the values we are given for the unit variable cost, the first one is 15 times 0.20. Like the second one will be 10 times 0.50. Then the third one will be 25 times 0.30. So how much are we getting here? 15 times 0.2 plus 10 times 0.5 plus 25 times 0.3. I can see we are getting 15.5. Then the third one and the last thing which we have to be computing, we are calling it the expected annual sales volume. The expected annual sales volume. Now, in this case, how much are we getting here? The first one I can see we have 4 times 0.4 times 0.10. Plus the second one we have 7 times 0.60. Plus the third one will be 9 times 0.30. How much are we getting? So it will be 4 times 0.1 plus 7 times 0.6 plus 9 times 0.3. We are getting around 7.3. Remember, all these figures are in millions of shillings. Once you do that, I just want to look on the stages of the computation of the NPV. One, we talked about the initial outlay. When I was reading the question, it means that we don't have any incidental costs, and therefore the amount which we are given on the first paragraph regarding to the cost of the plant will be coming automatically to be our initial outlay. So in this case, it will be 280. Number two, we discussed about the computation of these by taking the annual net cash flows. And I said, when you're calculating the annual cash flows, the annual net cash flows, you have to be looking on the cash flows provided, whether they are annuities or lump sum. Now, when I read the paragraph in, for example, we are being given a paragraph there. We are being told the plant is expected to have a useful life of 5 years, at the end of which salvage value will be nil. The farm's policy is to depreciate all of its fixed assets on a straight line basis. But we are being given here that the farms expect to incur or blah, blah, all that. We can be able to see it. But we are being told that due to the market uncertainties, the unit selling price, unit variable cost, and the annual sales volume of the new plastic rulers have been estimated stochastically as follows. So in this case, you can see the sales volume are going to be annually. We're going to be having an annual sales volume of expected annual sales volume of 7.3 million. So it means our question is annuity. So I just take 1 to 5 years. So let me take Kenya shillings, which are limited to millions. And I just want to remind you something here regarding to how you're supposed to be getting this question. You're not supposed to be having a lot of workings here. So in this regard, we can just be able to do it by getting our annual contribution. Let us look on the annual contribution. Annual contribution. I will just be able to remind you a certain formula here, where we said, take your selling price, you subtract your variable cost, then you multiply by sales volume. You multiply by sales volume. When you look on our expected there, we look on the first one, the expected selling price we are being given is that 7.5 minus the variable cost, which is 15.5. That one we subtract first, then we multiply by 7.3. We multiply by 7.3. So that 7.5 minus 15.5 times 7.3. It means we are going to be getting the annual contribution of 160.6. So that is where I start my question now. The annual contribution. My annual contribution will be 160.6. That is my annual contribution. Now from there, I just want to less the fixed cost. We have already been provided with it. So we less fixed costs under the additional information. So the fixed cost which we are being given is 30 million. right? What are we going to be getting down there? We are going to be getting pre-tax cash flows, or we talk about earning before depreciation and taxes, around 130.6. And we said we are using the simplest formula. So in this regard, let us less our tax first. Tax wenyewe. So less tax at 30%. So 30% of 130.6. I'm getting 39.18, right? Then we add depreciation tax shield. As you can be able to see on my videos, I have already told you that to get your depreciation tax shield, you normally take the cost minus scrap, right? We divide by the number of years. Then all of these we multiply by tax rates. So in our case here, the cost of this plant is 280,000, 280 million. We don't have a salvage value. We divide by the number of the project, which is 5 years. Then all of these we multiply by 30% as provided in the question. So it just means I need to take 280 divided by 5 times 0.3. This one we are getting 16.8. So what is our annual net cash flows? The annual net cash flows is how much? So it means I just need to take 130.6 minus 39.18 plus my answer, getting around 108.22. 108.22. Now, after you finish that, remember, this question does not have terminal cash flow. Why? It does not have a scrap value. Does not have a scrap value. So what am I going to be doing? I just need to take my years here. We have cash flows. We have the discount factor. We said we are discounting at which rates? Now, when I look at it, our discount factor is at 17%. 17%. Then we get our present values. Now, our years, we have 1 to 5 years, right? The cash flows which we are going to be generating each year is 108.22. Our discount factor, remember we are using annuity aspects. Our formula will always be 1 minus 1 plus R, we raise for negative N divided by R. You know, some students might be asking, Mwalimu, why are you not using the table? Because sometimes the discount factor provided in the question might not be existing in those tables. So I just want you to rely on using the percentages or the formulas. So in this case, I just take 1.17, I raise to power negative 5, 1 minus my answer, then we divide by 0.17. You're getting 3.1993, right? So 3.1993, we multiply by 108.22. I'm getting around 346.23. This is what is referred to as present value of the cash inflow, right? Present value of the cash inflow. Now from there, I just need to deduct as our initial outlay. Our initial outlay, you can be able to see it here. We said our initial outlay is 280. Then you can be able to tell us when our NPV is positive. How do we normally make our decision? Done. We're getting 66.23. 66.23. When the NPV is positive, how do you normally advise the investor? Let me look on someone here. Farida, welcome. Good to see you. We have Joanne. Which advice can we be able to give?
You accept the project.
Right. So we are being told here the expected net present value of the project, but due to our new students, we can show them that when the NPV is positive, we say we have to accept our projects. If the NPV is negative, we reject. And if, for example, our NPV is 0, it might be accepted. So in this case, we can say the company can purchase the plant, or can invest on the plant, can purchase the plant, since the NPV is positive. I know it is not a requirement in our question, but it might be a requirement on your coming exam. So that is one of the case scenarios. So all the advices we are providing, it means it is best, they are basically, we are targeting the outcome of our NPV once we do our computations. So after this, I don't know that, are we writing? Let me know whether you are finishing up or not, so that we can be able to determine our NPV. Let me know. Just flock on our chat room, and you continue telling me where you are done. Thank you, Terry. What about the others? Beatrice, thank you. Good. Chacha, thank you. Jose, Joan, sorry. Irene, we are doing well. So I just want to do the second requirement of the question. When I see the majority have already completed, it means we are all moving in the right direction. Sir Henry, welcome. Now, in this regard, because already we are done with the first requirement of the question, allow me to do the second. Allow me to do the second requirement of the question. Let us do the second requirement now. And remember, the second requirement, we are being told to simulate the data, or to simulate the net present values using the following random numbers, using the following, thank you, Farida, using the following random numbers provided. So in this case, I know that when you are simulating, let me just write here for you, number 2, we are saying the first step, we are saying that our first step is to get the random numbers. The first step is to get our random numbers, it should be the random number ranges. It should be the random number ranges. A minute, please.
William, if you're talking, I can't hear you.
Sorry for that. I have said, let me just repeat. I have said, let us first do I just want us to do our simulation as per the requirement 2 of the question. I think already we have been given the unit selling prices. In our case here, our unit selling prices we have been given in the question. So we have said, let us get the random number ranges. And our random number ranges, we have to be using the trial and error experiment. So I have just taken the unit selling prices together with the respective probabilities which are assigned to the unit selling price. Now, in that case, you need just to be accumulating the probabilities. So I take the first one, I put it here. Then I add the second probability. I get 0.70, 0.70 plus 0.3. We are going to be getting 1. So let us use the range number. Let us use the trial and error experiment. Remember, we are just coming like with a range like any other. So our first one will be 0, 0 to 29. You just need to subtract 1 here. You get 29. Then you take 29 plus 1, you get 30. 30 should be going to what? Because the range number, the random number ranges should be in ascending order. The same way, now we have 30, it should be going, you just need to subtract 1 here. This one now, when you are calculating the random number ranges, you take them like a full numbers, right? So this will be 69. Then the third one and the last one will be 70 to 99. Remember, this is 1. And then we understand this, if you subtract 1, it should be 0.99, right? 0.01 in that regard. Now, let us go to the second, where we are talking about the variable costs. So the variable cost provided in the question, we have 15, 10, 25. So 15, 10, 25. What do we have? We have respective probabilities assigned. We have 0.20. We also have 0.50. And the other one, we have 0.30. Let us now do our cumulative probabilities. 0.20, this plus this one is 0.70, this plus this is 1, right? Let us now calculate our range numbers. We have 0, 0 to 19. We subtract 1 here. Then we go to 20, 2. I can see here is around 69. Correct. Then we go to 70 to 99. Let us go to sales volume now. Sales volume. Let us go there to our sales volume. You can see the sales volume provided. We have 479. The assigned probabilities, we have 0.10. The other one we have 0.60, 0.30. So here we start with 0.10, 0.70, 0.3, 0.11, sorry, 1.00. Now, when you go to the range numbers, we start with 0, 0 to 09. We subtract 1 here. Then we go to 10 to 69. Then we have 70 to 99. I know very well that you are able to understand that concept. Once you get the range numbers, now we can come up with something called simulation worksheet. Let us come up with a simulation worksheet. The simulation worksheet which you are going to be getting here should be using, we are going to be assisted by the random number ranges, which we are, the random numbers, which the simulation random numbers, which we are being given down there. So in this case, we are going to be having, we are simulating for how long? Okay, it cannot fit here. So let me come up with a simulation worksheet here. I don't know whether you are able to see here, simulation worksheet. Simulation worksheet. Now, in that case, when you are calculating, we are going to be having random numbers, range numbers. It should be random numbers, right? We start with the first one. We are discussing about, this should be trials. Sorry for that. This should be a trial. How many trials are we working on? Then we have random number, selling price, random number, variable costs, random number, sales volume, right? Sales volume. Then we also have, due to the space which I have, I'm going just to be getting the annual earning before depreciation and tax. I put net cash flows, then I put NPV, so that due to my space now. So we have earning before depreciation and tax. We have earning before depreciation and taxes. We also have net cash flows. Then here we are getting our NPV. I don't know whether we are able to see the side of the NPV. I don't know where it is fitting up there. Correct. You can be able to see it. You'll be able to squeeze it. Now, in that case, I remember our question was asking us. Our question was asking us to compute what? Our question was asking us to compute something. Let me look on the question. Correct. Thank you. Now, simulate the net present value using the random numbers. Then, and compute the expected net present value of the project. So I will show you a simpler way of doing this. Let us first allocate the random numbers. How many trials are we given in the question? They have not given us any limits. So in this case, let me first analyze this. So we normally go row-wise when we are allocating those random numbers. For example, the first one will be 80, 25, we have 60, right? That is trial number one. The second trial will be 63, 83, 51, 63, 83, 51. We also have 05, 75, 05, 75, 05, 75, 30. The next one will be 15, 03, 53, 03, 53. The next one will be how much? We have been given 60, 37, 85. The next one we have 55, 55, 35. We have 25 there. 55, 35, 25, 24, 52. We have 39. The next one will be 36, 99, 48, 36, 99, 48. We have 16, 02, 16, 02. We have 52. The next one we have 85, 70. We have 15. We have 1, 2, 3, 4, 5, 6, 7, 8, 9. We have 10 trials. 10 trials, correct? Now, from that, I just want to work with the selling price of these random numbers. You just need to look on where your random number lies. Let me start with the selling price. So when I look on 80 here, I came to these range numbers. I look where it lies. 80 lies with the last range number. Then I look on the unit selling price. I say it's 50. The second one will be 63. I look on the range number of mine. I find it lies on the second range number. I go all the way to the unit selling price. I say it's 30. The third one will be 05. So 05 lies on the first range. I go all the way To the unit price, I find it is 35. Let us go to 15, lies on the first range number. I look on the unit selling price, I find it at 5. Let us look on the 60, lies on the second random. Look on the selling price, which is 30. What about 55? Lies on the second random number or range numbers. Then you look on the unit selling price, you find this is 30. 24 lies on the first. 24 lies on the first. The unit selling price is 35. Then we have 36. 36 lies on the second. The unit selling price indicated is 30. We go to 16. Our 16 on the first range, 35 here. Then 85 lies on the last one, which is 50. That is how simple the simulation is. Now let us look on the variable cost here, and I will be able to look on the 25. The 25 lies on the 20 to 69. The variable is 10 here. We look on 83. 83 lies on the last one, right, which is 25. We have 75 also on the same range. Here we are talking about 25. Let us look on 03. 03 lies on the first one, and we have 15 here. We have 37. So that 7 lies on the second one, and we have in 10. We have 35 lies on the second one, and we have 10. We have 52 also lies on the second range number, and we are having a variable of 10. 99 even, you can see it here, lies on the last one, and the variable cost is 25, correct? Then we have 02. 02 lies on the first one, and we have 15. Then the last one, which is 70, lies on the last range numbers, and the variable cost in that stage is 25. Let us go to sales volume now. When you look on the sales volume, we start with the first one, 60. 60 lies on the second range number, and we are getting 7 here. 51. 51 lies on the second here. We have a 7. 30. I think it's also here. 53, 7. 85. You can see lies there. Now we have 9. 25. Second one. 39. Correct. 48 there. 52. And then we have 15 also lies there. How are we going to be getting the earnings before depreciation and taxes? How are we going to be getting depreciation? Before, how are we going to be getting earning before depreciation and taxes? Now, in that case, to get our earning before depreciation and taxes, this is what I just want to do. Earning before depreciation and tax. We are going to be taking our selling price minus, right, our variable costs. We multiply it by the sales volume. Then we subtract our fixed costs. That is how we are going to be getting the earnings before depreciation and taxes. Let us start with the first one. And the process which you are going to be following here is similar to requirement number 1, which we have done earlier. So in this case, our selling price of the first row or our first trial, the selling price now is 50. The variable cost is 10. The sales volume is 7. So 50 minus 10, you get 40. Correct. 40 times 7, you get 280. 280 minus our fixed cost, which you have been given in the question, is 30. Right? We just subtract it directly. Minus 30, and I'm getting 250 here. Let us go to the second one. The selling price is 30. The variable cost is 25. We get 5. The sales volume is 7. We get 35. 35 minus 30, we get 5 here. 20 trial 3. The selling price is 35. The variable cost is 25, getting 10. 10 times 7 is 70. 70 minus 30, you get 40. Correct. Let us go to number 4. We are saying now the selling price is 35 minus 15, you get 20. Once we get 20 times 7, you get 280, right? 35 minus 15 is times 7. Times 7 is 140. 140 minus 30, you get 110. 30 on the fifth try is 30 minus 10, which you get 20. 20, 180. 180 minus 30, you get 150. Very simple. Then we go to trial 6. 30 minus 10 is 20, right? 20 times 7 is 140. 140 minus 30, we get 110. Let's go to another trial. I think it is trial 7. We have 52. Where are we? Trial 7, we have 35 minus 10. That 5 minus 10 is 25 times 7, 175 minus 30, we get around 145. Then you go to trial 8, 30, correct? 30 minus how much? 30 minus 25. I think it should be 25, yes. So 30 minus 25, that is 5, 35, 5. Trial 9, we have 16. We are doing it wrong. So we are talking about 30. 35 minus 15, we have 20. 20 times 7, 140 minus 30, we get 110. Then we go to the last one, 50 minus 25, 25 times 7 minus 30, getting around 145. 145. I think we are in agreement up to that point. We are in agreement up to that point of the earning before depreciation and taxes. That is how we normally get them. Now, let us move to net cash flows. So how are we going to be getting our net cash flows? Net cash flows. It means to get my net cash flows, as you look on your format, I cannot be able to write all that format here. Now should be on your mind. So to get the net cash flows, it means I'm going to be taking my earnings before depreciation and tax. Correct? Earnings before depreciation and taxes. Then first we get the net of tax by taking 1 minus 0.3. Remember, you normally subtract the tax times 30% times these. When you subtract, you get the net of tax of what we are doing, right? Then we add. What are we going to be adding? We add our depreciation taxes. Depreciation taxes. So let me start with the first one. We have 250 times 0.7 plus, how much was our depreciation tax sheet? We said it was 280 minus 0 divided by 5 years times 30%. So hii tulipata ngapi? 280 divided by 5 times 0.3, 16.8. That is how you do it, 16.8. So what is our answer? It means I just take 250 times 0.7 plus 16.8. The first one I'm getting 191.8. 191.8. The second one will be how much? So in this case, I take 5. So just check here. 5 times 0.7, right? Plus 16.8. 20.3. The third one will be 40. So it will be 40 times 0.7 plus 16.8. Getting 44.8. The other one will be 110 times 0.7 plus 16.8. Getting 93.8. The other one will be 150 times 0.7 plus 16.8. 121. 121.8. The other one will be 110 times 0.7 plus 16.8. Getting 93.8. The other one will be 145 times 0.7 plus 16.8. Getting 118. 118.3. And the other one will be 75 times 0.7 plus 16.8. Getting 69.3. The other one will be 110 times 0.7 plus 16.8. We are getting 93.8. The other one will be 145 times 0.7 plus 16.8. I'm getting 118.3. 118.3. That is how you normally get your net cash flows. 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 So what do we need now? We need to get our, sorry for that. We just need to get our NPV. So how are we getting our NPV here? To get our NPV, we are going to be taking the net cash flows. Net cash flows. We multiply by the present value interest factor annuity. The discount factor in our case was around 17%, 5 years, minus our initial fee. That one should be on your mind again. This one we were able to get earlier. How much did we get? It was coming to, let us use just the formula. If you don't remember like me, it was 1 minus 1.17 raised for negative 5 divided by 0.17. So you just take 1.17, you raise for negative 5, 1 minus answer, you divide by 0.17. We get around 3.1993. Our initial play was around 280. So let us give an example of the first net cash flows. Our first net cash flows was amounting to 191.8. So once I take 191.8 times 3.1993 minus 280, the first one should be 33363. 123.63, right? The second one now. The second one will be 20.63 times 3.1993 minus 280, getting a negative, right? We're getting negative 214. Let me just round off 214. The other one will be 44.8 times 3.11998 minus 280, getting negative. Sorry for that. So let me just proceed. The next one was 93.8 times our discount factor. So which is the 3.1993 minus 280, which was our initial outlay, getting 20.09. 20.09. The other one will be 121.8 times 3.1993, right? Minus 280, getting 109. 109.67. The other one will be 93.8. I don't know whether I have it. Yes, it is here. I just put here 20.09. The other one I have 118. I don't have any other 118. So it will be 118.3. 118.3 times our discount factor, which is 3.1993 minus 280. We are getting 98.48. You have 69.3. I don't have any other. 69.3 times 3.1993 minus 280, getting negative 58.29. The other one will be 93.8. 93.8 times 3.1993 minus our initial, which is 280, getting 20.09. The other one will be 118.3 times 3.1993 minus 280, getting 98.48. Get your summation here. Get your summation of NPV. So it will be 98.48 plus 20.09 plus we have negative 58.29 plus 98.48 plus 20.09 plus 109.67 plus 20.09 plus negative 136.65 minus 214 plus 333.63. You get it 291.59. 291.5. 291. Just confirm is something there. Let us repeat trial number 8. Trial number 8 might be giving us the wrong answer. So trial number 8, we have the selling price of it is 30, right? The variable cost of it is 25, getting 5, times 7, which is 35, minus 30, we should be getting 5. The earning before depreciation tax, which is okay. Then 5, now I'm just repeating it from here. We have 5 times 0.7 plus 16.8. This one is wrong. This should be 20.3. It's the only one which is wrong, 20.3. Then, if it is 20.3 and we want to get our NPV, I just take 20.3 times 3.1993 minus 280. It should be 20.3 times 3.1993 minus 280. We should be getting around negative 215. Just put 215 here. Here 215. We should be negative. So in this case, I just take 3.6563 plus negative 214 minus 136.65 plus 20.09 plus 109.67 plus 20.09 plus 98.48 minus 215 plus 20.09 plus 98.48. 98.48. They're supposed to be getting around 135. Equivalent, it should be 135. 135 should be our answer there. 135. So the biggest question would be, how am I going to be taking, or how am I going to be getting the expected NPV? I say, take the summation of NPV, you divide by the number of trials. So in our case, we have 135, you divide by 10, we are going to be getting 13.5 million. 13.5 million. 13.5 million. 13.5 million. Let me see someone who is asking a question. Mwalimu, I can't see the right-hand side of the board. Anyone else who can see it? Apart from Rose Mwangi. Let me see. You able to see now?
Yes, iko sawa.
Okay, thank you. So let me know when you finish writing so that I can do the last. So let us do our next illustration for the simulation analysis. Just to do a question which was tested on November 2016. November 2016. Farida, now you can read for us this question. Go on. Farida? Dawn, can you read for us, please?
SKB Limited is considering a proposal to manufacture a new drug, Millennium. The drug will be manufactured using a machine which will cost 13 million shillings. The cash flows and drug life relating to Millennium have been estimated to stochastic exogenous variables with the following distribution of return from the is 10%. The company has approached you as a financial management expert to perform an analysis of the project above required using the following random numbers. Perform 10 simulation runs of the present value of the project. 2, determine the expected net present value of the project.
Thank you, Dawn, and sorry for the challenge you are getting with your network. The SKB Limited is just considering a proposal to manufacture a new product, and it is not called Millennium. So this product will just be manufactured using the machine, which will be having an initial outlay of 13 million. So the cash flows and drug life relating to Millennium have been estimated. Remember, you are being given the annual after-tax cash flows. In this case, we have been told that they have been estimated as stochastic exogenous variable with the following distribution. So examiner has already given you the drug life with the probabilities, the annual after-tax cash flow with the probabilities you simulate. So in this regard, we start the question the way we said. This question, we are going to be starting it similar to what we have done so far. The question was tested in November 2016. Question number 1B. It should be 1B, yeah? So in this case, we just want to simulate, right? We want to simulate the question. So in this case, I'm going just to be taking the annual after tax cash flows, annual after, annual, right? We are given after tax cash flows, after tax cash flows, we are being given probabilities. We have cumulative probabilities. Then we come up with range numbers. So the first one, the first thing that we have to be doing here, the first thing that we will do in this case, we will be copying our after tax cash flows. So 1,000, 1,500, we have 2,000, we have 2,500, yes, up to 4,000, 2,500, 3,000, 3,500. Then we have your 4,000 there. 1,000, 15, 2, 25, 3, 35, 4,000. The probabilities we have 0.02, 0.03, right? 0.02, 0.03, 0.15, 0.15. We also have 0.30, 0.20, 0.15, 0.15. Now, I want us to do cumulative probabilities. We start with 0.02, 0.2 plus 0.03, 0.05, plus 0.15, we get 0.20, plus 1.5, we get 0.35, 0.65, 0.80, 880, no, 85 here. Then we have 1 there. Now we have our duty to determine the range numbers. The first one we said we subtract 1 here. So it will be 00 to 01. This one will be 02 to 04, 04, 05 to 19, 20 to 34, 35 to 64. Right? We have 65 to 84. Then we have 85 to 99. You remember we said we are using a trial and error experiment and we are subtracting 1 from our probabilities, and we add 1 on the right hand side of the range numbers. Now, when we go to the drag line, our drag line now, in this case, we are being given drag line 3, 4, 5, 6, 7, 8, 9, 10. I think they are following in ascending order. 6, 7, 8, 9, and 10. So the probability is given here. You have 0.05. You also have 0.10, 0.30. We also have 0.25, 0.15. We have 0.10. We also have 0.03. Then 0.02. Let us accumulate. We start with 0.05, 0.15, 0.45. I know that you are able to understand how I'm doing it. This plus this one, 0.70. This plus this one, 0.85. This plus this, 0.95. This one plus this one, we get 0.98. Then we have 1 there. Let us do range numbers. We say we subtract 1 here. So it will be 00 to 04, 05 to 14, 15 to 44, 45 to 69, 70 to 84, 85 to 94, correct? Then we have 95 to 97, then we have 98 to 99, 98 to 99 there. Now, I want us to come up with a simulation worksheet. And I just want to have a very simple simulation worksheet. So let us come up with simulation. Let us come up with simulation worksheets. And we are going to be having our trials here. Right, so we have our trials. We have random number, annual net cash flows. Let me just write it that way. We have random number. We have drag life. Drag life there. Then we are going to be computing our NPV. How are we going to be computing our NPV? I will be able to show you. Now, we are being told to use only 10 trials. 10 trials. And the random numbers are already given there. So we start with 53. We have 53. The other one is 97. Yeah. Next we have 66, 99. The other one would be 30 to 1. 3081, 1909, 1909, 3167, 3167, 8170, 8170. We have 3875, 3875. We have 4883, 4883, 9033, 9033. We have 58, 52, 58, 52. Sometimes they might be giving you the trial, the random numbers which exceed the trials. So once you reach the requirements, you just stop at that point. 5, 6, 7, 8, 9, and 10. There are only 10 trials. So let us start with the annual net cash flows by looking on the random numbers on the ranges. On the ranges provided. So I will start with the first one. The first one is 53. When I look on the 53 where it lies on the range numbers, the rate it lies on that 5 to 64. When I go there all the way to after net cash flows, I will be able to get 3,000 here. 66, it lies on this range. So you just need to read your after net cash flows, 3,500. We have 30. That lies on the 20 to 34. Then you go the way and you read your net annual net cash flows of 25. We have 19. We go the way and you read your 2,000 on your left-hand side. That one also lies there. We have 25. We have 81. 81 lies here. 65 to 84. You're getting that 5. Then we have 38. 38 lies here, where we have 3564. 3564 is where that it lies. And you can see the annual after net cash flows is 3,000. The next one will be also 3,000, 48. Random number 90 lies on the last range, 4,000. Then we have 58. 58 lies on 3564, getting 3,000. Let us go to drag life now. The drag lives, we start with the 97. You can see 97 lies on the second last. We have 9 on the far end. 99, we have 10. We have 81. 81 lies where? Here, right? 7. 09, here, 4. 67. Where is 67? 67 lies here, 6. 70 here, 7. 75 there, still. 83 there, 33. 33 lies where? Where 33? Where 33 lies here, 5. Then we have the last one, which is 52, lies on 6. Very good. How are we going to be calculating the NPV now? How are we going to be calculating the NPV? We are going to be taking, this one we are going to be taking the annual net cash flows. Let me take the first one. Remember, these are the drag life. Imagine 9 years getting 3,000 every year. So it means they are all annuities. So the first one will be 3,000 times the present value interest factor annuity. Which percentage are we using? The discount factor provided in the question, we are being given 16%. I'm just writing the first one so that you can be able to understand. 16%, 9 years. Then minus your initial outlay. Our initial outlay yetu ni ngapi? As per the question. How much was our initial outlay? You remember the initial outlay of the question was 13,000. So how much is this? So I will just be able to compute this one. That one, 16% of 9 years, right? You just need to use this formula. 1 minus 1 plus R. You remember this formula of ours? That is the formula we are going to be using all through. So let me start with the first one. We are going just to be taking 1.16. We raise for -9. 1 minus answer, we divide by 0.16. I'm getting around 4.6065. Let me just put it here. 4.6065. How are we getting it? Remember, I have already said it is a present value interest factor annuity, 16%, 9. I said you use this formula. 1 plus R raised power negative n, you divide by R. In this case, we have said is 1 plus 0.16. You raised power negative 9, you divide by 0.16. That is how I was able to arrive to this one. So our answer will be 4.6065 times 3,000 minus 13,000. Our answer here should be, now that we have reached here, let me just put it here this way. Our answer should be 819.5. 819.5. 819.5. 819.5. It should be like that. Now, the other one will be, remember now we are going to the second one where we are dealing with 10. So it will be the present value interest factor annuity, 16%, 10 years, right? So remember what is changing here will be the n. So I just need to take 1.16. I raised for negative 10 now, right? 1 minus answer, we divide by 0.16. What I'm getting is 4 points. 4 points. Now this one will be that 500 times 4.8332 minus 13,000. We are getting how much? We are getting how much there? So in this case, we just take that 500 times 4.332 minus 13,000. Getting 2162. 2162. 2162. 2162. Am I getting the correct discount factor? Let me check. 1.16. I raised for negative 10. 1 minus answer, we divide by 0.16. 4 point something. So 500 times 4.8332 minus 13,000. It should be around, if it is wrong, it should be 3916.2. The other one will be how much? This one will be 2,500 times our discount factor. Now we are changing to 7. Our end just be changed to 7. So it will be 1.16. You raised for, you can see that it's 7. Raised for 7 negative 1 minus answer. 1 minus answer. Then we divide by 0.16, getting 4.0386 minus our initial outlay, which is 13,000. So we are getting how much? So 2,500 times 4.0386 minus 13,000. We should be getting negative 29. Negative 29, 2,903.5. 903.5. This should be negative 2,500 times 4.0386 minus 13,000. It should be 2903.5. The next one will be 2,000. 2,000 here times. Let us change here now to 4. 1.16, you raise for negative 4. 1 minus answer, we divide by 0.16. Getting 2.7982. minus our initial outlay, which is 13,000. So I just need to take 2,000 times 2.7982 minus 13,000. Getting negative 7403.6. This one will be 2,500 times 6 years. We are to do 6 years. So 1.16 raised to negative 6. 1 minus answer, we divide by 0.16. I'm getting 3.6847 minus our initial outlay. How much are you getting? 2,500 minus, times 3.6847 minus 13,000. We're supposed to be getting negative 3788.25. The other one will be 3,500 times. Remember now we are dealing with 7. We have the discount factor for 7, 4.0386 minus our initial play. 3,500 times 4.0386 minus our initial play of 13,000. Get 1135. 1135.1. The other one would be 3,000. 3,000 times 4.0386 minus the initial play. How much is this? 3,000 times 4.0386 minus the initial play of 13,000. We are getting negative 884.2. The other one will be 3,000. This one is the same. 33. Okay. So our answer here also should be negative 884.2. Now, the second last we are talking about 5. So it will be 1.16. 1.16. We raised for a negative 5. 1 minus answer, we divide by 0.16. We get around, it should be 4,000 times 3.2743 minus the initial outlay. We should be getting how much? 4,000 times 3.2743 minus 13,000. We should be getting 87.2. Then the last one we have a discount factor here. We just need to take 3,000 times the 3.6847 minus 13,000. So huku tunapata ngapi? 3,000 times 3.6847 minus 13,000. Getting negative 1945.9. So what is the summation here? What is the summation there? What is the summation? What is the summation there? What is our summation up there? What is our summation now? So in this case, you just need to take your summations down there. So 819.5 plus 3916.2 minus 2903.5 minus 7403.6 minus 3788.25 plus 1135.1 minus 884.2 minus 884.2 plus 97.2 minus 1945.9. Right? We should be getting negative. The summation of our NPV should be negative 11,842. Give you a round off. So get your expected NPV. We need to take the summation, negative 11,842 divided by 10. So how much is this? will be 11. It will be negative 11. I'm very tired now. Negative 1184.2. Negative 1184.2. Negative 184.2. So in this case, when you are making your decision, you should tell the investor, for instance, the project is thus not acceptable because the undertaking the project shall reduce the value of wealth of shareholders. Remember, by 1,184,200 in present value terms. I have said that if you are to make the decision, you say the project is not acceptable because undertaking the project shall reduce the value. We'll be able to reduce the value of wealthy of shareholders by 1,184.2 million. Is it millions? It should be millions or in thousands. Should be somewhere. Let me look on the question. It was limited to what? In thousands. It should be just if I just want to write it, it should be like that. Because it's limited into thousands, just multiply there by 1,000, and then we get 1,184,200 Kenya shillings. That is a negative, and therefore for the project should be rejected with all means, with all means, with all means. Any question up to that point? Let me know whether we were able to copy up to the last thing, because next week we shall be able to finalize these techniques and look on the replacement, a question of replacement of machine. And once we finish, because I think we should be finishing our topic next week, so that on the end of June, we can be able to start. Once I start portfolio theory, it will be finishing on that end week of June. Then July, we're going to be dealing with 3 topics, which I'm very aware that we are going to be finalizing them on the 3rd or 4th week of July, so that I can give time for revision as we prepare for our exams. Now, I have said the next technique of valid risk, we are going to be looking on sensitivity analysis. Sensitivity analysis together with scenario. This one we are going to be doing one day. Scenario analysis. So don't miss out. Don't miss out, Rose. Don't miss out. So that is what we are going to be doing on Wednesday, hopefully. Then we will be able to finish with the rest. The rest are very brief, so that we can go a bit quick to finalize the key areas which we think they are of great importance to you. So any question up to that point?